Every major financial firm on Wall Street employs financial analysts who are responsible for providing in-depth analytical reports on the performance of companies within a particular business sector or for an entire industry. They're expected to spot trends and report developments that investors can use to decide on which stocks to buy, hold, or sell. The analysts that work for these large international corporations have access to some of the most expensive and in-depth tools and information in order to make predictions on how companies and sectors are expected to perform in the future. And becoming a Wall Street analyst is one of the most competitive jobs in finance and probably in all of corporate America. According to websites like Investopedia and Indeed.com, in order to become one of these analysts, you need a seriously impressive resume to simply get your foot in the door. Some of the requirements include an Ivy League college education, an internship at an investment bank, and becoming a chartered financial analyst, which involves passing 3 exams that are so difficult that less than 10% of candidates actually make it through them all. But if you are able to achieve all of this, then you have a good chance of getting hired as an analyst at a bank like Goldman Sachs. And yet, despite having all of this knowledge and experience, as well as having the best resources to research and forecast markets, experts still get calls wrong all the time. They even get paid massive salaries in the 6 figures to regularly get predictions wrong. So in today's video, we're going to take a look at a handful of stocks that Wall Street analysts have been giving buy recommendations for a while that I seriously disagree with. We're going to analyze each stock, and I'll make my case as to why I personally think that all of these investments should be avoided. I'll also recommend a better alternative investment for your consideration. So now let's go ahead and get started. The first stock we're going to take a look at is for Agnc Capital Management, which is ticker symbol NLY. According to stockanalysis.com, 17 analysts have recently submitted ratings for this stock, and it currently carries a buy rating. Some of the firms that have a positive outlook for this stock include the Royal Bank of Canada, Barclays, and Bank of America. Agnc Capital is a diversified capital manager that engages in mortgage financing and corporate middle market lending. The company invests in agency mortgage-backed securities, mortgage servicing rights, residential mortgages, and corporate debt. It's a mortgage REIT that's required to pay out 90% of their earnings back to shareholders in the form of dividends. Upon first coming across this company, you'll notice a couple things that really make it stand out. NLY currently offers a dividend yield of 13.15% as of the making of this video. It's also a relatively cheap stock at just $6.69 per share, which some people may see as a plus, but in reality a cheap stock doesn't really make a difference. Agnc Capital is also one of the oldest mortgage REITs in the industry, and they're currently the largest in the industry, with a total portfolio of over $80 billion according to their latest investor presentation. With this kind of power behind it, it makes Agnc Capital a very appealing stock to a number of investors. But if we research a little deeper into this company's performance, we can start to see cracks in this company's stock. Expanding their stock's share price performance, we can see that this company was performing pretty well between 1997 and 2009, at least for a mortgage REIT. But then starting in 2009, this stock has continued to go on a downward trend in terms of share price. From September of 2009 until today, Agnc stock has kept moving downward, where it's now lost over 65% of its value. If we also look at their dividend distribution history, we can see that they've reduced their dividend a total of 7 times within the last 10 years, which is extremely disappointing. When combing through their financial statements, we can see even more concerning issues with this company. One of the most important metrics for an M-REIT can be found on their balance sheet. The book value for a lot of financial companies, including mortgage REITs and business development companies, represents the objective value of a company's assets, or in this case, Agnc's debt portfolio. A sizable falling book value for these types of companies always translates into dividend cuts. And if we take a look at Agnc's book value by quarter, we can see it's continued to go down, especially since 2017. I could go on, but given everything that we've looked at so far, I'm seeing way too many red flags with this company, and I don't get why these analysts have continued to recommend buying this stock. Is it possible that Agnc could turn things around? Absolutely, but I'm not interested in trying to make that bet. It's hard to find an alternative stock out there that offers such a huge dividend yield and is even moderately risky. If you do want to pursue an alternative M-REIT out there with a better track record but still carries high risk, one suggestion could be Mrcc Capital. This is a mortgage REIT in my portfolio that I hold a very small position in. It offers a massive dividend yield of over 12%, but I would consider this to be one of the riskiest, if not the riskiest investment in my portfolio. So make sure that you're fully aware of the risks before investing in Mrcc Capital for yourself. This next stock is one I see my viewers talk about all the time, but I'm just not a fan of it for a few reasons, which is Agnc Investment Corporation, ticker AGNC. On stockanalysis.com, a total of 19 analysts have submitted a rating for this stock within the last month who have given it a buy consensus. Just like with NLY, some of these firms having a positive outlook for this stock include the Royal Bank of Canada, Barclays, and Bank of America. The RBC is actually predicting a 12% rally for this stock, but back on November 1st, they somehow predicted a 43% rally, which obviously didn't come true. In reality, Agnc cratered 22% since making that prediction. But just like with Annaly, Agnc Investment is also a mortgage REIT that invests in residential mortgage pass-through securities and collateralized mortgage obligations. This is a really popular stock pick among dividend and income investors for a number of reasons. Just like with Agnc Capital, Agnc offers investors an insanely high dividend yield of 11.51% according to Google. It's also a relatively inexpensive stock that isn't as pricey as other REITs like WP Carey or Simon Property Group. But unlike Agnc Capital, Agnc has one even greater incentive to offer investors, which is that their stock pays monthly dividends. If a good dividend stock happens to pay investors on a monthly basis as opposed to a quarterly basis, I think we can all agree that that's the more preferable choice. But when we take a look at similar metrics to that of Annaly, we can see a lot of concerning things about Agnc as well. For one thing, their stock share price has also been really disappointing, just like NLY's. In August of 2012, this stock hit an all-time high of around $35 per share, and it's continued to fall since then. For 3 months in 2013, this stock's share price actually crashed by roughly a third, and despite a slight recovery, it still continued to fall for nearly a decade. Also like NLY, this stock's dividend has been cut about 8 times within the last 10 years. Originally paying $1.25 per quarter, or I guess 41.6 cents if you want to divide it by 3, it now pays 12 cents per share. That's a decrease of more than 71%. Their financial statements have also painted a very bleak picture for this company. Going back to their book value on their balance sheet, we can see that their book value has kept falling. In less than 10 years, their book value has gone down by more than half. It's even been accelerating downward more within the last 3 quarters, as you can see, meaning that their mortgage portfolio has been suffering pretty badly. It's important to remember that MREITs are required to pay out 90% of their earnings back to shareholders. That means they only get 10% of their earnings to do things like pay their employees, cover operating expenses, and so on. As you can imagine, that doesn't leave a whole lot of money left over to try to grow their mortgage portfolio. This is why looking at an MREIT's book value is extremely important, because it shows how well the management team has been doing at picking investments, which Agnc clearly hasn't been doing a decent job in my opinion. If I could give an alternative investment for your consideration, one stock that I own is Ares Commercial Real Estate Corporation, ticker ACRE. This company has a great management team behind it who also manage my favorite business development company. But look at ACRE's book value over the years. Very consistent, very well managed up to this point at least. ACRE doesn't pay monthly dividends and it offers a lower yield, but the share price and dividend amounts haven't been cut over and over again like they have with Agnc. The next stock we're going to look at is Monroe Capital, ticker MRCC. They're a business development company that specializes in customized financing solutions in senior, unitranche, and junior secured debt. They invest in companies located across the United States and Canada, and they invest in companies with an EBITDA between $3 million and $35 million. Their stock currently carries a buy rating, in fact almost a strong buy rating according to stockanalysis.com, with 4 analysts saying strong buy, 3 saying buy, and 2 saying hold this month. Offering a really attractive yield of 11.12%, Mrcc stands out as being one of the highest yielding business development companies in the industry. Their stock doesn't get nearly as much coverage as other BDCs like Ares Capital or Prospect Capital, but their stock still carries a better buy rating with analysts than some other similar companies. Monroe is one of the smallest BDCs in the sector with a total portfolio of $536 million. To put that into perspective, the largest BDC, which is Ares Capital, has a total portfolio value of roughly $20.4 billion. Monroe Capital, in my opinion, is probably going to be the best stock we're going to look at today, but the company's performance still raises red flags for me in a sector with a ton of better options. For one thing, their stock has fallen considerably more than most business development companies this year, with their stock being down roughly 20% for the year. It's about on par with the MREITs, Agnc, and NLY we just looked at, but many other BDCs are only down about 5 to 10% this year as of the making of this video. But in terms of dividend distributions, Monroe has a better track record compared to what we've already looked at. Since their IPO, the company's increased their dividend once, but they also slashed it once by about 28% during the pandemic. When I look at this company, I just have to ask why bother, because it has an 11% dividend yield. I get that it offers one of the highest yields in the sector, but if you just invest in a BDC that offers a little less, you can experience much better share price performance and no drastic dividend cuts up to this point. There's just a lot better options out there where you don't need to expose yourself to the elevated risk with this particular company. Just by looking at their net asset value, it's continued to fall over the years, which isn't a good sign for a BDC. I cover these kinds of investments on my channel all the time, so if you watch my videos on a regular basis, you'll know which ones are my favorite. Ares Capital is the largest BDC out there, as I previously mentioned, and they've been a very well-managed company throughout the years. More recently, they've been able to increase their dividends at a faster rate, which shows they've been doing a pretty good job managing their debt portfolio. Main Street Capital is another well-managed BDC that yields much lower but offers really good long-term growth. Plus it pays monthly dividends and the occasional special dividend sometimes. But to summarize, you don't need to throw your money into Monroe Capital because there's just so many better options out there worth investing in. This last stock we're going to look at today is one that still blows my mind that these financial institutions are still recommending. The stock I'm talking about is Orchid Island Capital, ticker ORC. A total of 7 analysts have given a rating for this stock this month, with 2 saying a strong buy, 2 giving it a buy, and 3 saying hold. This gives ORC a slight buy rating, as you can see on stockanalysis.com. This is a company that invests in residential mortgage-backed securities, or RMBSs, in the United States. Their loans are backed by single-family residential mortgage loans referred to as agency RMBSs. Whatever you do, do not be fooled by the extremely large dividend yield this stock offers. ORC is a very common investment that people who are brand new to dividend and income investing make without realizing what they're actually investing in. When you look at this stock and see that it offers a dividend yield of 22% and it pays monthly dividends, it looks like a great buying opportunity. But it's really important to not just chase stocks offering the highest dividend yields. I started criticizing this stock in a video I released back on January 28th of this year, and since that video came out, the share price of Orchid Island has collapsed by more than 32% and they've reduced the dividend. If you're wondering what's up with that massive dividend they're about to distribute, it's not due to this company getting its act together and finally offering investors a good return. The reason for this massive dividend this month has to do with ORC performing a reverse stock split of 1-to-5. This means that for every 5 shares of this stock that you own, you'll now only own just 1 share. I suspect the company is doing this because the share price keeps plummeting, and I don't believe that this is going to benefit the stock whatsoever. Since their IPO, this stock's share price has fallen by more than 81%, and the dividend has been cut 8 times in the last 10 years. Their financials also show a bloodbath across the board. Their book value has been absolutely demolished over the last decade, where it's now all the way down to $2.86 per share. In their last quarterly report, Orchid Island reported an EPS loss of $1.18 per share, which is awful. This company cannot last much longer posting results like this. Personally, I really don't believe this company will still be around in 5 years. I've already talked a lot about this company, so I won't go too much more in depth, but I'm always advising everyone to stay away from this stock. There isn't another stock out there I'd recommend with a 20% dividend yield, but for your consideration, one suggestion would be Starwood Property Trust. This is actually a hybrid REIT, which means they invest in both mortgages and physical properties. And that's going to conclude our look at some stocks that I personally believe are being incorrectly rated by these financial firms. I think I've provided enough reasons to avoid every stock on this list, although you are free to disagree for yourself. Like I said, I hope these companies can turn their lucks around, and I hope I'm wrong in saying that these stocks are bad. But I'd rather invest in stronger, well-positioned companies as opposed to trying to catch falling knives. Whatever you choose to invest in, be sure to perform your own research and due diligence before investing and come to your own conclusions. And that's going to conclude today's video. Thank you all so much for watching. I really do appreciate it. If you found this video informative, please consider giving it a thumbs up below, and also subscribe to the channel if you want to see more high-yield dividend investing strategy videos. It would just let me know that there's enough people out there who want this kind of content, and I'll continue to provide you all with that content. Alright, thanks again guys so much for watching, and until next time, take care.